Joining us more to talk about investor sentiment, it's Scott Chronert, U.S. equity strategist at Citi. Scott, explain this.
Sure.
I thought all the sentiment readings were so down in the dumps. You're seeing euphoria?
Well, it's a good point. Yeah. I mean, the index is comprised of roughly 10 inputs, and they're moving in different directions. But I think versus the past week, we've seen a pickup in a couple of the inputs that have triggered the index back modestly into euphoria territory after being in a more neutral range for the past month or so. And so, we're keeping an eye on the various inputs, but the net effect of this is to underscore some of the conversation in the last few minutes that, heck, market's been actually fairly resilient since the Fed's first rate hike a while back. And so we just need to be prepared for, ongoing bouts of volatility in response to this.
Right. So your argument is, and you're looking at it really near term, just in the last week, the resilience of the market is making people feel a little better about it, and therefore that's a warning that there's more downside ahead? Is that the takeaway?
Yeah, I mean, I'd say, look, we're still moderately positive for the rest of the year. We think we can get to 4,700 in the S&P, up 5 or 6% from here. I think earnings are going to be the driver of that. But along the way, we've got a lot of inputs that we need to factor in, both geopolitical, economic, and of course, from a Fed monetary perspective. So I think this notion of volatility being with us for a while is, I think, probably the important take-home message here. And the Levkovich index just gives us another way of reading this and preparing for it, particularly as we head further into the earnings reporting period.
Losing a little steam here into the close, down 1.1% on the S&P. You had industrials turn red, so now it's just staples, utilities, and energy higher. Scott, have you changed your views at Citi about the sector performance and where you want to be in the market? More defensive, perhaps, less cyclical,
right,
given all the changes we've been going through?
So what we've done is through a factor lens, is we've really highlighted quality as the factor that we want to be attentive to. And essentially what this does is give us a means of navigating sort of a mixed value versus growth circumstance. And what you get with quality are going to be those types of companies that presumably have more pricing power against an inflationary backdrop. And we think that this is an appropriate approach for navigating this ongoing period of volatility, as we're watching the extent to which the Fed goes down its more hawkish path.
Mike, what do you make of the quality trade as sort of a related call to a defensive trade?
Yeah, it absolutely. Almost everything that you would look at in terms of, where we are in this cycle on the later side, where we are in terms of the profit trajectory, feeds into that idea. You want companies with better balance sheets, more resilient profit margins, things like that. The bit of a trap, as we talked about earlier this week, is that a lot of the quality screens really surface a ton of NASDAQ mega cap growth in tech stocks. So there's a way to, obviously mitigate that. You could look in other sectors. You could basically look at things like shareholder return, buyback and dividend strategies, which have done relatively well. So I guess you kind of have to, settle on your definition of quality, but it generally, does make sense and it has been working modestly. What
about that, Scott? And what about tech and its setup into earnings as we get sort of knee deep going into next week?
Yeah, well, so I guess what I would say on that, the setup for tech, obviously, we're of the view that as we go through the Q1 reporting period, you're going to see, generally speaking, a more normal positive surprise circumstance across the board. Obviously, what's going to come into question are outlook commentaries from a variety of different sectors. When you look at tech specifically, yes, it does tend to carry a positive quality attribute to it. But what I would also point to is, as we talk about this real rate discussion, and we look at where the sensitivity to real rates is, just keep in mind that rising real rates is more of a headwind for growth, i.e. tech, than it is for value, i.e. other areas more defensive and economic sensitive to the market. So we have to keep an eye on this toggle between what fundamentals are telling us. The quality attribute is a way of navigating this, but at the same time, rate direction is going to have, and particularly real rate direction, is going to have a big impact on how the near-term trading unfolds.
Scott Chronert, thank you.